How I Trade Crypto, a detailed, practiced guide to research, risk management, and long-term thinking. I've been trading and investing in digital assets for more than a decade, on and off, through bull runs, crashes, forks, rug pulls, and protocol upgrades. If there's one fundamental lesson the markets have taught me, it's this. Do not buy a token without researching everything that matters about it. Know the project's economics, technology, people, adoption, liquidity, legal risks, and exit options. Never buy blind. Never rely on hype. Below, I've rewritten and expanded your piece into a comprehensive guide you can use as a checklist and reference. It's written for traders and investors with experience, practical, detailed, and actionable. 1. The core rule. Research everything. Research everything about the asset that you want to invest in. That principle sounds simple, but it requires discipline and a systematic approach. What research everything actually means. Tokenomics, total supply, circulating supply, emission schedule, inflation, deflation mechanisms. Market structure, market cap, liquidity, trading volume, exchange listings. Technology, smart contract code, consensus model, audit history. Team assets, governance, who runs it, their track record on-chain governance. Adoption, use cases, real users, revenue, partnerships, integrations. Risks, security, regulatory, concentration of supply, token unlocks. Exit plan, how and when you'll realize profits or cut losses. If you only remember one thing, prioritize verifiable facts over PR, hype, and social media sentiment. 2. Why market capitalization matters. But don't treat it as everything you recommended, focusing on tokens with high market capitalization. And there's sound reasoning behind that. Why market cap is important. It's a rough proxy for how much capital is required to move the price. Higher market cap, generally less volatile and harder to manipulate. Projects with larger market caps are more likely to be listed on reputable exchanges, have more liquidity, and attract institutional attention. Many institutional and index products require minimum market cap or liquidity conditions. Important caveats. Market cap alone doesn't equal quality. A large market cap can be misguided if the tokenomics are broken, the team is anonymous, malicious, or liquidity is locked in a few wallets. Smaller cap tokens can produce huge returns, but with correspondingly higher risk, illiquidity, rug pulls, volatility. Market cap eats price x circulating supply. Manipulation or sudden token releases, vesting, lockups ending, can massively change the market cap quickly. Practical rule. Use market cap as an initial filter for stability, but always deep dive into tokenomics, liquidity depth, and concentration. 3. Emotional control. Don't let gains turn into bad decisions. You wrote, don't allow yourself to get too excited when you are gaining on your investments. This is crucial. How emotion ruins trades. Overtrading, chasing price spikes, or taking unnecessary leverage. Changing your plan. Moving stop losses, abandoning profit targets, or increasing size impulsively. FOMO reinvestments, reallocating gains into unvetted projects because you feel invincible. Practical tactics to stay disciplined. Write a trade plan before you enter. Entry, position size, stop loss, profit targets, and an alternative "why I'll exit early" clause. Use automatic orders, limit take profit stop loss, where possible to remove emotion. Predefine allocation limits per tier. Core holdings, swing positions, speculative moonshots. Log your trades and review them monthly. Learn from what worked and what didn't. 4. A comprehensive due diligence checklist, step by step. Use this as a checklist every time you consider investing. A. Tokenomics. Supply mechanics. Circulating supply versus total supply. Are many tokens locked or scheduled to unlock soon? Emission schedule and inflation rate. Is the token inflationary or deflationary? Token distribution. Founders, team, seed investors, advisors, ecosystem treasury. What shares do they hold? Utility. Is the token required for protocol fees, staking, governance, or only speculative trading? Are there buybacks, burns, or token sinks to reduce supply over time? B. Liquidity. Market structure. Daily trading volume, USD, and volume market cap ratio. Order book depth on major exchanges. How much slippage for a 5-10% buy-sell? Number of exchange listings and types, CX versus DEX. Presence of large wallets, whale concentration, look for 10% in few addresses. C. Technology. Security open source code. Active commits on GitHub. How many contributors? Independent audits from reputable firms. Trail of Bits, Certic, QuantStamp, OpenZeppelin. Read the audit reports and the list of findings. Bug bounty program, security insurance or treasury for hacks, smart contract upgradability, what governance controls can change contracts. D-Team advisors. Backers. Are team members publicly verifiable? Do they have relevant backgrounds? History of previous projects and track record. Are there credible investors or VCs backing the project? VC backing is helpful but not infallible. Check for red flags. Anonymous team, fake LinkedIn profiles, plagiarized white papers. E-product and adoption. Is there a working product, a mainnet, or just a white paper? Real metrics, active addresses, TVL, total value locked, transactions, revenue streams, integrations, partnerships, and real enterprise clients if relevant. Roadmap realism, specific technical milestones and timelines, not just vague promises. F community. Governance community size and quality across Discord, Telegram, Reddit X, Twitter. Governance participation rates. Are on-chain votes active or largely controlled? Developer ecosystem. Number of dApps, SDKs, developer onboarding. G legal, E regulatory jurisdiction of the team and corporate entities. Token classification risk. Utility versus security. Does the token exhibit features of a security, revenue sharing dividends? AML KYC stance and compliance with local laws, especially if the project targets regulated industries. H financial a business model revenue model. Fees, subscriptions, data sales, enterprise contracts. Cash runway. How much treasury does the project hold and in what assets? Market fit. TAM, total addressable market, and plausible adoption curves. Exit liquidity plan. How easy is it to convert to fiat? Are there fiat rails available? Tax considerations. Are you in a jurisdiction with clear crypto tax rules? Slippage fees to exit a position of the size you plan to hold. 5. Practical metrics to calculate examples and formulas. Market cap. E's current price. X circulating supply fully diluted market cap, FDV. E's current price X total supply volume market cap ratio. E at 24H volume market cap. Lower suggests low trading interest. Higher suggests active trading. Liquidity depth. Sum of bids and offers within plus 1% or plus 5% of mid-price on major exchanges. Supply concentration. Piece of print of circulating supply held by top-end wallets. On-chain explorers can show this. Use tools like CoinMarketCap, CoinGecko for basic metrics, and EtherScan, SolScan, BSCS Scan to inspect wallets and contracts. 6. Red flags that should immediately worry you. Anonymous core team with unverifiable claims. Token distribution heavily skewed to insiders. 30–40% in few wallets. No audit or failed audits with unaddressed critical issues. Sudden, unexplained changes to tokenomics or vesting schedules. Low liquidity paired with high social media hype. Pumpiest dump risk. Promises of guaranteed returns, buybacks that aren't on-chain, or MLM referral schemes. Centralized control of a supposedly decentralized protocol. Admin keys not renounced and not multi-sig. If you see multiple red flags, walk away or keep position sizes tiny. 7. Position sizing, allocation, portfolio construction core. Holdings, blue chip projects, Bitcoin, ETH, major layer, 1s, 2s. Long-term, lower allocation volatility. Growth holdings, projects with strong fundamentals. Adoption, medium allocation. Speculative moonshots. Early stage, low market cap tokens. Small allocation, e.g. 1–5% of portfolio. Risk per trade. Never risk more than X% of your portfolio on a single speculative trade. Common rules, 0.52% per trade. Rebalancing cadence, monthly or quarterly. Avoid daily tinkering. Because your stake here is small, 15, the risk of ruin is low, but the same rules scale. Limit concentration and know your worst case scenario. 8. Exit strategies. Profit taking partial. Take profits, scale out, sell portions at predetermined levels, 25% at target A, 50% more at target B. Trailing stop losses. Protect gains while allowing upside. Time-based exits. If adoption doesn't meet milestones by certain dates, reevaluate. Event-driven exits. Adjust position if audits fail, team leaves, or regulatory actions start. Always have a written exit plan before entering an investment. 9. Security custody practices. Use hardware wallets, Ledger, Trezor, for long-term holdings. Understand the risks of exchanges, custodial risk, jurisdictional risk, forced delistings. Use multi-sig for treasuries or significant holdings where possible. Back up seed phrases securely, not digital natives like cloud or screenshots. Keep private keys offline and segregate funds across accounts if needed. 10. Taxes. Record keeping. Keep precise records. Date of purchase, cost basis, chain token, exchange wallet address, and sale data price. Recognize taxable events, swaps, airdrops, staking rewards, lending interest. These can all be taxable in many jurisdictions. Use portfolio trackers and tax software to generate reports, Coin Tracker, Coinly, etc. 11. Tools, resources I use regularly. Market data, metrics, CoinGecko, CoinMarketCap, Nomics, on-chain explorers, Etherscan, SolScan, BusEScan, DeFi dashboards, DeFi Llama, TVL, Dune Analytics for custom metrics, audit info, project docs, Certique, Trail of Bits, Open Zeppelin reports, order execution, eDepth, Binance, Coinbase Pro, Kraken, or depth charts in TradingView. Portfolio SE Tax, CoinTracker, Coinly, Community Signals, GitHub activity, Discord Telegram engagement, developer meetups, Newsy analysis, project blogs, Medium, protocol forums, and reputable crypto news outlets. 12. Sample research workflow. Do this before buying. 1. Price check as market cap filter, quick sanity check. 2. Read the white paper. Does the value proposition make sense? 3. Check tokenomics on the tokenomics or light paper page. 4. Inspect smart contract. Verify token address on Explorer. 5. Open GitHub, activity, recent commits, contributors. 6. Search for audits and scan the reports. 7. Check liquidity, exchange listings. 8. Identify top holders and unlock schedules. 9. Read recent community updates, AMAs. 10. Scan for news or partnerships. Watch press releases versus verifiable integrations. 11. Make a worst-case scenario assessment, e.g. 90% drawdown, hacks, legal issues. 12. Decide position size and set entry-stop targets. 13. Execute with predefined orders where possible. 14. Final thoughts. Discipline over drama. It's tempting to believe that one hot tip will compound a portfolio into wealth. The reality I've learned over 10+ years: consistent, disciplined research and risk management beats a string of lucky hits. Markets are a machine that rewards patience and punishes impulsivity. Key takeaways: research deeply and methodically. Use market cap as a stability indicator, but validate everything else. Keep emotions out of the decision loop. Predefine your entry and exit. Protect capital first, then pursue upside. Log trades and learn continuously. All the information in this video is based on actual facts and was researched, prepared, and presented by Jeremy Bennett Miller.